Welcome to TheoTrade. This is Don Kaufman here, doing the weekend update on August 25th, 2017. Well, let's start with kind of a week in review, and then of course we'll be forward-looking, see what some of the price action has in store for us next week, what we should be looking at. First, we start with the fact that on this Friday, what did we see the markets end with? Well, for the most part, the markets ended today, well, up a whole point and 50 cents, massively unchanged, people. But that's not what we're looking at in the current chart. I'm going to start with a week in review here at TheoTrade with looking at a comparison chart. Now, if you've never looked at a comparison chart is prototypically done on a percentage basis. So let's go through a little bit of this comparison. The primary symbol that I have listed is the QQQ. Okay, where is the Q actually found? Right up here, and this is the Qs. Okay, the Qs on a year-to-date basis, because again, we're looking on a year-to-date chart. The Qs are up about 18.76 year-to-date. Now, this is incredibly important, and I'm absolutely going somewhere with this because there has been, if you will, a divergence in the force this very week. So the Qs are up about 18%. On a year-to-date basis. In the middle over here, what do we have? We have the spiders, which is representative of the S&P 500. S&P 500 up about 8.5% year-to-date. Coming in last, but definitely not least, the IWM. It's the little guys, the little engine that could, which is only up on again, year-to-date. It's basically flat. It's a 1% move. So why am I starting the week in review with this comparison chart, the Nasdaq versus the S&Ps versus, of course, the IWM, which is the Russell? Why start here? Because there's a big time convergence going on right here, right now. And you can kind of see it on this year to date. We're going to zoom in specifically to get a better feel for this, but what we are seeing when I say there's a divergence or a convergence in the force, let's be very, very specific with this. The Nasdaq right now, okay, this week was weak on a relative basis versus the IWM. So the underperformer is relatively strong, the top performer is relatively weak. All right, why should you care about that? Well, for the most part, the gains in the S&P 500 this year, this S&P 500, that 8%, okay, has everything to do with what the Nasdaq is doing. And the Nasdaq, okay, is displaying weakness relative to the rest of the marketplace. And that's why I'm starting with it, okay, and probably going to be finishing with this as well. It's of critical importance. Now we're going to take this to a much tighter time frame. We're going to look on a 3-month basis, because in a 3-month basis, you're really going to see it, okay? Here you actually have specifically, I'm going to highlight it, that, okay, is the latest move inside of the Nasdaq, and all of a sudden, the little engine that could, the Russell over here, is as strong as can be. This is not a healthy sign for ultimately the markets. I don't think enough people are picking up on this. Now, let's start to look at some of the individual issues before we really go any further, because we all have to realize, all right, what's driving the Nasdaq. Okay, so we'll look at the Nasdaq again on a percentage basis. Year to date, it's up about 18%. What's driving the Nasdaq? You know as well as I do. It's the Microsoft. Microsoft's up, what, 16% year to date. Microsoft, interestingly enough, is weak on a relative basis versus the Nasdaq on a year-to-date basis. Then we'll actually look over at Facebook. Facebook, okay, this week, I don't necessarily think per se that this is a scary chart. I don't get too much into the technicals of it. Again, is it dangling off the edge of a cliff? Maybe, okay? But, you still have to actually fathom the point that it's up, 42% on a year-to-date basis over here. Then we cruise down to Apple. And Apple, okay, unscathed this week. It's still up 37% year-to-date. We come into Google. Now, Google, and I talked about this a bit earlier in the week, this, I do believe, is a very, very scary premise. Google actually cresting, and the level right here, and I'll put it up here, is 920. And Google is currently trading right here at 930. Google, I think, is dangling off the edge of a cliff. Any further, and Google could actually break down quite considerably. Google, though, you really need to respect the fact that, and again, I'm leaving this on a percentage basis for a reason. If you take a look at the Nasdaq itself, and I'm going to go back to the Nasdaq for a second, it's up 18%, right? Google has thought of one of, it's the power inside of technology out there. It's one of the powers that be. It's, what they call the FANG stocks. Yeah, well, you have a FANG stock here since its earnings was up 23%. Now it's only up 15%. Okay, it's actually weak versus the Nasdaq itself. Not enough people are talking about, again, that relative weakness inside of Google. Now, the most interesting product of all, Amazon. Well, why are we actually going to signal out Amazon? Amazon was up from the earnings over 40% year to date. Now is only up 25% year to date. Right here, this is your relative weakness. Now, Amazon, okay, is driving a tremendous amount of the order flow inside of the spiders, inside of the Nasdaq over here. And the Nasdaq, again, if we see continued sell-side activity this next week in Amazon, you are going to feel it hard inside of the Nasdaq futures, the Qs, okay, and ultimately the S&P 500. Again, these are the underlyings that have been driving most of the gains to the S&P 500. And again, I don't think enough people are looking specifically at Amazon. Now, another way to look at this, and I think this is probably the most cohesive way, if you will, to look at it. I've taken the liberty of adding the symbols together. I took 6.5 times Facebook plus 6.5 times Apple plus 13.9 times Microsoft plus Google plus Amazon to come up with this kind of composite quote. Now, I call this the monsters of technology. Why do I call it the monsters of technology? Well, for the most part, it is what it is. You start to zoom in, okay, on this. The monsters of technology have not fared well in recent weeks. They've been stopped dead in their tracks. Now, the reason I'm bringing this up, okay, and again, you're looking at this composite quote, okay, that right now is up 27% year to date. And we'll just zoom out for a second and jump right back to the Qs, okay? And you can see the Qs also stopped ultimately dead in their tracks, up again 18%. This needs to be watched, again, like a hawk this next week. We have, again, a number of the monsters of tech that are hitting these kind of key threshold areas. And I really want to specifically look at Amazon, as it does appear to be breaking down. In terms of Amazon, let's look at it uniquely. And we're going to go under option statistics. The IV percentile is also starting to get to a more elevated level. So for the most part, what it's displaying is the 55th percentile. Okay, all that really means is if you took a look at implied volatility, right? IV goes up and IV goes down and IV goes up and IV goes down. Typically, IV goes up before earnings and then it falls after earnings. But right now, implied volatility is slightly elevated. It's about, okay, the 55th percentile over there. It's only slightly elevated. But listen, we don't have any earnings on the horizon. So you're starting to see risk is gathering in Amazon, but it's by no means extreme. And that, I think, to me is a little bit of the scary part of this, is we've already seen the underlying after earnings. It has fallen, okay, since its earnings day, 15%. You're like, okay, so what's the point, Don? Well, the point is, stock that falls 15%, implied volatility barely moves. Boy, this stock could fall a lot more before implied volatility really starts to rock. And that is the direction I do believe that Amazon happens to be headed out there. Now, let's go a little bit beyond technology. I've talked about financials almost, to death over here. Financials also took it on the chin, of course, in the previous week, having a little bit of a rally back. At this point, very suspect to the rally back inside of financials. I believe it's just a bounce that's ultimately going to be sold into. So why am I looking at financials and saying, well, the financials came off hard and fast and bounced, okay? That's prototypical. I mean, even if you saw something like Amazon at this point, it's had 15% down with very, very little bounce over there. Even if Amazon bounced, I would look to sell into it as well. But the XLF is still in a fairly ugly looking chart over here with a quick bounce. Again, I believe ultimately will be sold into. Why do I think that's going to be sold into? Again, I don't look at a chart per se and say, well, you know, it's strong here and weak here. That's not me at all. I'm not into technicals. The reason I think that the XLF will be sold into, take a look at the bonds. The bonds are rallying. Okay, that's taking interest rates down. You want to look at interest rates over there? Take a look. It's called TNX. What does it stand for? We're all the way back to like 2.1% on a 10-year in the interest rates. That's interest rates going down. How is the XLF sustaining? Okay, how is the XLF sustaining itself in an incredibly low interest rate environment? So really, I'm not so much talking about, you know, oh, from a technical standpoint, this bounce is going to be sold into. Okay, I think the bounce is just natural occurrence after the product ultimately moved down. However, there could be tremendous downside inside of the financials as well. So we're kind of getting, if you will, to almost like this perfect storm of, and no pun intended for those of you that realize that if you're in Texas, there's a hurricane coming. Anyway, no pun intended whatsoever with that. But we are looking at a little bit of the perfect storm in terms of risk in the marketplace where, again, you have the bonds in not just an elevated, but in a dangerously elevated state. You have the XLF that just simply looks like it bounced a little bit. Amazon has been coming off a lot. Now, let me add to that a little bit. Now, again, ever the bear? Maybe. Okay. But the point that I also want to make over here before I look at some of the expected moves, the VVIX. I talked about this quite a bit earlier in the week, but I want to reiterate a point. The VVIX is the volatility of the volatility index. You're like, okay. Again, many of you might look at the VIX, okay? The VIX it's an age-old way of looking at risk. People call it like the fear gauge. Call it whatever you want, okay? Here's the bottom line. The VIX only moves when traders, okay, are really buying puts specifically in the SPX. And the puts that they have to buy to move the VIX have to be an average of 30 days out. Okay, what is the VIX? All right, let's get to specifically. I know, again, you're like, why are you looking at the SPX? Because that's what the VIX is. The VIX is nothing more than a measure of volatility, okay, in the SPX options, but it's a 30-day volatility. And the irony of the VIX is, when I say it's an age-old product, okay, there's not a lot of activity anymore in the SPX options that are this far out in time. Like 30 days is like ancient history. And those that are kind of in the know in trading, those that kind of know what's going on, they're not using puts in the VIX, all right, puts in the SPX. Let me be very, very specific over here. They're not using puts in the SPX to hedge anymore, okay? So you're not going to see the big impact specifically to the VIX. What traders are doing is they're actually trading VIX options themselves. So why would a trader, okay, that's a portfolio manager, choose to use the VIX options over the SPX options? Like, why would they choose one or the other? And the answer is actually quite simple, okay? When the markets start to sell off, okay, if you're a hedger, what's a hedger? It's somebody trying to reduce risk. If you're a hedger, what do you want when you're going after and buying a hedge? What do you really want? And think about this, again, logically to yourself. You want the best bang for your buck. You want the best bang for your buck. So if the market starts to sell off, whatever you're using as your hedge, you want the hedge to explode in your face, right? That's going to actually save you the most money if you're a hedger. The SPX, it's not doing it anymore. The SPX is just totally like suppressed volatility. They're not using these SPX puts. They're using the VIX. Okay? Why are they using the VIX? Because the volatility of the VIX is insane. It's exploding higher, okay, at the slightest sign of risk. Hence the VVIX. What again is the VVIX? It's the volatility of the volatility index. If you look at the VIX, and the VIX is at like 12. I mean, legitimately, you look at the VIX, fall all the way back. It fell all the way back again to 1128. So the volatility of the S&P is 11.28. What's the volatility of the volatility index? Okay, like what's the volatility of the puts, okay, and calls inside of the VIX itself? And the answer is, on average, 95%. 95%. Now think about this, okay? The VIX is at 11. The VVIX is at 95%, and this blows people's minds. Nobody, okay, cares anymore about those SPX options. All they care about is the VIX options. The VIX options now are their hedge. And I'll remind you, the VIX options saw an explosive move all to the way to 135. And even the previous week, they got back up into the 120 category. What this means, categorically speaking, what it means to move the VVIX, there has to be tremendous activity in the what? In the VIX options themselves. And I know this stuff gets wildly convoluted, but there's tremendous activity inside of the VIX options themselves. So I'm going to open up the VIX options, and I'm just going to show you what volume and open interest happens to look like in here. Let's just open up every strike there is. All the strikes. I'm just going to highlight something for a second. Look at the open interest in here. Behold. Okay? Hundreds of thousands. That's almost 700,000 contracts open of one strike. Now granted, you know, it's an $11 product. You got to trade a whole lot of contract size. But why am I bringing this up this week? Because I want you to remember, okay, that just a week ago, we had a VVIX all the way at the 120, which means that a huge amount, again, of the professional trading arena, they still have their hedges on. Just because the VVIX fell back down doesn't mean like, put away your weapons and ammo. Just kidding, false alarm. It doesn't mean anything. We're only 5-6 days removed from the fact that everybody bought their hedges. And because they bought those hedges, okay, risk is still going to be relevant into the future. Why is risk still relevant into the future? Because all those hedges out there, let me show you again the VIX options. All the hedges out there, people, they're still on. Just because the VVIX dropped back down doesn't mean that the entire professional world, okay, has got what? All of the risk mitigation tactics, they're all still on. There's 25 days left between now and the September expiration of the VIX options where that huge open interest is. In the next 25 days, because there's all these hedges on, that unto itself increases our risks for a major market move. And I want you to think about that, because if you see something wild happen in the next 25 days, first of all, September, historically speaking, the most volatile month out there, right? Everybody always thinks October is the most volatile month. Well, yeah, some crashes possibly happened then, but September, okay, happens to be pretty much the most volatile month, you know, in recent records out there in terms of market moves. So again, keep in mind, everybody still has their hedges on. The VVIX may not have to go back up, but risk is still prevalent. And that's one thing I want you to think about just the next couple of weeks moving forward. Now, speaking of risk moving forward, last week we had over $40 expected move. This coming week, check this out in the SPX, this coming week, which ends, and I'll tighten up the number of strikes here, it ends on September 1st, okay? So there are 7 days to the expiration, and we're dropping all the way back down to an 8.2% volatility, which is the equivalent of a $23 expected move. We're only expecting to go up 23 bucks or down 23 bucks. We're back in this disgustingly low volatility. We just came off of a week. We had over a $40 expected move. We have about almost half of that right now in terms of option premium. One very other unusual aspect of this week coming, we have a Monday expiration, right? We have a Wednesday expiration. We also have a Thursday expiration. Why? Because it's end of the month, and we have a Friday expiration. One of the coolest things I've seen in a long time in the SPX, you have 4 expirations in a 5-day week. Again, volatility, right? This previous week we're coming out of, $40 expected move. This coming week, $23 expected move. No way am I selling premium, okay, after some of the moves that we've seen in some of the recent weeks. There's just no way. Volatility collapses that fast. It's not going to be me. I'm not stepping out there and selling premium in that. The next thing, we have the QQQ, okay, in the Nasdaq. Taking a look at the Nasdaq, its volatility also has contracted substantially. The Nasdaq is coming down to $1.90 higher or lower in the expected move. Once again, I am not selling premium in that. No way, no how. Okay, this is stuff that you need to think about. Again, in the coming days over here, we have got a lot of what appears to be of products that are sitting on key thresholds. Yeah, the VVIX. Okay, we have Amazon that's broken down. But moreover, again, the Nasdaq is weak on a relative basis. Thanks everybody for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.